host, Dinesh. And Dinesh Williams, we've had a long relationship. We appreciate you joining us here on the Roundtable. We're here, the first Thursday of every month, same link, same time from 6 to 6:30. So let's jump off and talk about some lending and see where things go tonight.
Well, thanks for having me, Ebony. So hello, everybody. I'm Dinesh Williams. I've been in the mortgage business for 10 years as a loan originator. Spent 4 years before that as a loan processor. So I've had a variety of roles in the industry, and I've also worked at various companies of various sizes, from small brokerages to the largest banks in the country, and so on. So I've seen it in terms of how each lender operates and what their different tolerances or preferences are in terms of the types of loan scenarios that they're best at. And I've found out that I've seen that every lender is different, even though they offer the same service. Usually what they focus on is different from place to place. The place I'm at now, Princeton Mortgage, they do a wide variety of loans, so they're able to help a lot more people than I was able to do before. So we do have foreign national loans, for instance. We have a rehab loan. So it's quite a few things that we have in our toolkit that you might not typically see at other places. We're licensed in 42 states, so pretty much all of the country. So there's really a lot that we can do to help your clients. Now, what I wanted to talk about right now was where we are in terms of mortgage rates. In the last few weeks, rates have actually gone down. Rates are the lowest now that they have been since September. They're hovering just above 6% right now. Now you'll notice that the Fed raised rates the other day, but mortgage rates have come down. Why is that? Well, that's because mortgage rates and the rates that the Fed controls are different. What the Fed controls is a short-term interest rate, and a mortgage, of course, is a long-term rate. They don't necessarily move in tandem. Sometimes they do, sometimes they don't. Based on what economists are expecting right now, they're expecting that rates are going to come down even further over the next few months. So this is good to know, because we are in a typically slower time of the year. But based on where rates are, we can certainly expect business to be picking up towards the end of this quarter and into the second quarter of 2023. So, I think there's certainly some light at the end of the tunnel based on where we've been the past few months. And, I'm looking forward to this rising tide lifting our boats, and that we'll all have a very productive 2023 together. Does anybody have any questions for me?
I do. Dinesh, can you take a moment to educate those present about how mortgage rates work? So the way the market is kind of laid out, and what's actually influencing mortgage rates in particular, like the bond market, et cetera, that's, raises mortgage rates versus what's impacting auto loans, so that folks get a better understanding of, kind of what's really influencing their ability and their buying power. Because ultimately what we're talking about is purchasing power. Higher mortgage rates means lower purchasing power. Lower mortgage rates means higher purchasing power.
Right. So okay. So in terms of, I'm gonna take because there's a lot that you're just asking. So I'm gonna take it in stages. So first thing is, how are mortgage rates determined? So basically, the rate is really determined based on the 10-year Treasury. So that's a long-term interest rate that's pretty much set by the government. And mortgage rates, basically the 30-year mortgage, which is the most popular mortgage, basically takes its cue from that rate. Now, what has happened in the last year is that the spread or the difference between what the 10-year rate is and a 30-year mortgage has gotten pretty big. So while the 10-year treasury, I don't have the number in front of me, whatever that number that is, the amount that the 30-year fixed is compared to that rate has been unusually high. And part of the reason for that is that, as everybody knows, we've been having a lot of inflation over the, in this post-pandemic time. So the rates have had to go up to compensate for that. And what we've been seeing in the last few months is that based on what all the indicators are showing, is that it looks like inflation has essentially peaked. And we're now at the point where rates can now start to go down because prices are not rising as fast as they were previously. And the Fed has also somewhat responded to this, because when they raised rates this week, it was at a lower amount than they did previously. So that's what goes into setting the mortgage rates, the general rates for a mortgage. But there are also individual factors that go into that as well, because depending on your credit score, you might have, and depending on the type of loan that you get, you might have a higher rate than somebody else. So that's also very important to bear in mind, that not only are, there's general factors in the economy that affect the mortgage rate, but also your individual credit score. So that's why it's very important to make sure that you keep your credit score as high as possible. With some mortgages, your credit score is not so much of a factor. If you get an FHA mortgage, for instance, or if you're eligible for a VA mortgage, those two loan programs are pretty much one size fits all, meaning doesn't matter if you have an 800 score or a 650 credit score, everybody's going to get the same interest rate. But if you're getting what we call a conventional mortgage, which is from Fannie Mae or Freddie Mac, then your credit score is super important. And you could be in a situation where just having your credit score 20 points less than it should be will result in you paying a lot more interest than you need to. So that's also on the individual level. That's something to really bear in mind, that it's always good to have your credit in the best shape possible. And that's something that we can discuss with you and guide you in terms of how to keep your credit in the best shape possible. Mohammed, you had anybody else had any more questions for me?
I kind of have a question for the floor, really, just to kind of stir the pot a little bit, because, a month ago, a client, had asked, should I be waiting to buy? And I said, absolutely not, because, the rates are doubtful that they're going to go down, and then they went down. So what do you say? I mean, I'm tempering what I say now, because I kind of feel like I went too far as to, say something, but, because the rates have gone down, do you think they're going to continue to slide? And what has this really meant for, you as a lender or other lenders who are out there, or realtors? I've seen an uptick in my business lately. So I think that, despite the going back and forth, people are still out there, they're still buying.
Yeah, sorry, I didn't catch you after the going back and forth.
Yeah, so I guess the basic question is, do you think the rates are going to continue to slide, or do you think that this little dip is going to be the end and the bottom of it, and then they're going to continue to go back up?
So based on what I've read so far, the expectation is that this slide is going to continue into the second quarter. So I would say this is actually more than just a blimp. This is an actual trend where rates are going down at the moment. Because again, part of what goes into setting rates is what investors expect in terms of long-term inflation, and it seems so far that we've basically gone through the worst in terms of inflation, and that going forward, the rate at which prices are increasing is going to decrease, and therefore mortgage rates should also continue to stay lower than they were before. So I think that there's going to be, at least for the next quarter, or at least for the rest of this quarter, there's going to be more stability with more mortgage rates, and they're also going to continue to stay low. That's the current expectation.
So is it for the first time in history, or are we telling people to kind of pump the brakes and wait to see what the interest rates do?
I mean, this is the conversation I would have with anybody that wants to buy a home. I would say, there's really no right time to buy a home, and the bottom line is, if you can afford it now, it's the best time to get into the market and own something. Because if your rate is high now, well, guess what? If we end up in a recession later this year or next year, rates will more than likely go down, and you can refinance. Also, prices are lower than what they were a year ago, and I'm sure that this is something that you're seeing on your side. So there is a balancing point where, yes, rates are high, but then if the prices are lower, then you're certainly not worse off in that situation. So I'd say anybody that wants to buy, no is always a good time.
Dinesh,
go ahead.
Go ahead. I thought I heard Pritish.
Yes, yeah. Hi. I was just going to say, I've also what I've been doing in recent years is telling my buyers, depending on their own perceived financial strength, to what Mr. Williams just said, if they have the financial depth, then they can, go ahead and buy when the interest rates are a bit higher, because they can expect a lower price. And then for a while, you might pay lower property tax. That does happen in Virginia. And then when interest rates go down in the future, you can always refinance. So I think it also depends on the buyer's financial profile.
Definitely.
Nikki, what are you telling your clients? If you were, yeah, that's, if your mic is on, I'm curious, because we're lucky to have, industry professionals on the line. And so I would like to know, because there's things that are, the market's kind of going like this. And so what are you seeing, and what are you telling folks?
Can you hear me now?
Yep, we're hearing you now.
Awesome. I'm still figuring out this computer mic thing. You would think I'd have it after 2 years of COVID. I would echo Mr. Williams' sentiments. Like, if you can afford it now, let's go, let's jump in. Because not only can you refinance, and also the price interest rate kind of seesaw, don't play the game, I guess, is my general message. If you need a house, you want a house, you're ready to go now, don't worry about the market factors, because they're going to go up and down and things are going to change. But if you need to be in a house that's in the school district or a certain radius from work or whatever, let's go now. I did have a question though for Mr. Williams, if I may. And
sure,
full disclosure, I'm a loan officer too. So I don't want to poison the well here, but I do have kind of just a general industry or professional question. How are you best supporting your real estate agents? Because what I'm finding is that I'm having the same conversation twice, like once with the buyer, once with the agent. And even if we all have it together in this kumbaya three-way call, I don't leave with a real good feeling that my real estate agents are supported either with information or detail specific to this buyer. So just I don't know, pro tips, how are you best supporting your realtors?
A good question. So, I mean, it's me personally, I love to inform everybody that's in the transaction, the buyer, the realtor. So I try to give as much pertinent information as possible and try to be available throughout the process. And so really that's the main basis of how I'm able to support my realtors. And also, I'm also doing constant outreach just to let them know, hey, I have this new program. These are what the trends are in the industry in regards to rates and so forth. So I'm always, just trying to keep the lines of communication open. And you're right, there are not many resources out there to, I guess, really inform realtors of what the lending process is like. It's basically for most realtors, it's like a black box. I send the deal here, and then I wait to close. Yeah, I do enjoy, interfacing with my agents and trying to really, expand their knowledge of the business that much more. And that's really what I try to do.
Yeah, and that's fair. I mean, I said to an agent not too long ago, we have bigger fish to fry. And I think in general, folks kind of understand that sentiment, but this realtor went off the deep end. Like, what do you mean? We got this? And I was like, no, I was trying to like kumbaya you and pull you in. And that ended up being the nail in my coffin. So I'm just kind of scathed and looking for pro tips. So I appreciate that. Thank you.
Dinesh, I have a question for you. And also same question for Nicole, because you guys are both industry experts that we rely on here. So the first question is, as a lender, what are your thoughts on the health of like first-time home buyer programs like the Maryland Mortgage Program that really kind of got beat up during COVID, and more recently as well with the spikes in interest rates? When the interest rates went up to almost 7, that pretty much kind of shut a lot of things down for a lot of the first-time home buyer programs. So I wanted to get your thoughts there, as well as what are some of your thoughts on things like the mortgage credit certificate, which was a great option for home buyers that's now kind of in jeopardy in a lot of places around the country. So I want to get your thoughts there.
Okay. So honestly, my knowledge of the Maryland program isn't that great. But I would think that going forward, a lot of these state funded programs are probably going to become even more essential. So hopefully they're going to get the money that they need to continue to service these programs. Now, and also in terms of the mortgage credit certificate, I think that's also probably going to be a little bit harder going forward, being that lender margins are being squeezed at the moment. So those programs going forward, I'm not sure what that's gonna look like exactly. But I think with prices softening and sellers being more amenable to paying closing costs, that's probably going to be a good alternative for some buyers. In other words, so they might not be able to rely on state-specific programs, but sellers might be more amenable to helping with closing costs. Well, what are your thoughts, Nicole?
Yeah, I mean, I think the programs are well funded. They are massive in DC. I mean, HPAP, the juggernaut in the room, or the elephant in the room, is giving up to $202,000 for down payment.
206.
Well, with closing, right? And the mayor, this is DC, got through that mayor Black home ownership program. Ask me how she got legislation through that specifically says this is for Black and brown people. I don't know how she made it happen, but it's there. It works. And I'm doing it. It works, right? What I think the challenge is going to be is, to Dinesh's point, lender margins are razor thin. So there's money out there. There's well-funded money. There is like strangely backed and marketed money for down payment, but you got to find a lender to give you the rest of it, right? And I only get paid, and my company only gets paid on how much we lend. So if you're getting $200,000 from a program and another 20% from the mayor's home ownership down payment program, and they will also give you closing, now you got a hard time finding a lender who's going to give you $100,000 loan amount, right? Or $120,000 loan amount on a $430,000 house. In the spirit of full disclosure, the only way we're doing it is volume. There's no way I could afford to have 2 borrowers that are only getting $100,000 from the bank, right? From the bank. And I got to do all this extra work for all these other programs. So I think, to get to the heart of your question, I think it's going to get harder, not because the money's not there, not because of interest rates, not because of any of that stuff, but because of capitalism. Because Wall Street's got to want this paper, they got to buy this paper, and you got to find a bank that's going to jump through all those hoops to get it to you. And that's getting harder and harder. The more money they give away, the harder it is for us to package and sell it. I mean, this is like the truth bubble, right? So I think those are the challenges you're going to face, not the money, not the down payment, not even the credit profile, to piggyback off of an earlier comment. But this is capitalism. At the end of the day, you got to be able to sell it, and that's getting harder and harder.
And
So
that's a
you
huge
think that
paradigm
it-
shift. Hold on one second. But that's a huge paradigm shift because these programs were taking a monster hit recently because interest rates were so high, and these programs have interest rates that are higher than normal because of the amount of money is being put forward. So now you're saying, like, when interest rates coming down, like, that interest rate is not the issue with the program. It's the lenders. Getting a lender to back it is now the problem.
Yeah, and that's where you got to kind of take a surgical knife to it, right? Because in Maryland, yeah, their money is attached to an interest rate, but they're really, and I'm going to say only, I know that's like a poisonous word, but they're only giving you 3%. And yes, there's an interest rate associated with the larger loan, right? So in Maryland, I don't think my concerns are that valid because they're giving you such a low dollar amount. That's kind of the historic down payment program, right? You get the 3%, take the interest rate, you refinance it, pay them back, and you're good. But in DC, where you got this 20% down program from the Mayor's Home Ownership Fund, you've got DCHPAP. Those programs don't have an interest rate attached to them. All right.
And
so you can get whatever interest you qualify for.
Yeah, so the 202,000 max that the DCHPAP provides, that's unrelated to the price of the, I mean, it's not a percentage of the purchase price or anything.
Right.
Mm-mm.
No, it is based on your
based on
household
income.
size and income. And
Yes.
even, I mean, 202 is a huge number, but the lowest dollar amount you get is $80,000. That's still a lot of money. So if I'm at the bottom end of that scale, I get 80K and there's no interest rate attached to it, but I still have to sell it into the street and all the rest. And Mohammed, I wanted to get to the other part of your question, the MCC. That's a beautiful program. And you said it was in jeopardy though. Did it stop? I know Maryland still had it. DC had stopped it for a while, but is it gone away now?
There are a lot of municipalities across the country that have put an indefinite pause on the MCC. So it's not just Maryland. I think DC put a pause on it. I'm not sure about Virginia, but there are other states, and I can look it up. But it's kind of on pause in a number of places.
Yeah.
Would you say that this is almost an administrative kind of thing then, that the red tape and, administering, the loans are really the problem versus the actual money being there? Is that kind of what I'm hearing?
That's the bottom line. That's what it boils down to. I mean, if you have a buyer who's getting, let's split the baby, right? Let's say they're getting $100,000 from HPAP. They're buying a $400,000 house. They're borrowing $300,000 from the bank. Okay, $300,000 loan, that's a healthy loan amount, but I have to now turn around and sell that to Wall Street, which ultimately means somebody's huge retirement fund. It's like the CalPERS, the California Retirement Fund, or TIAA, or one of those folks. And they're looking at this through the lens of the last market crash saying, hey, this person's getting $100,000 from a program. So they are effectively getting 100% financing with an okay credit score and no reserves in the bank, and et cetera, et cetera, et cetera. So yeah, it becomes an administrative sale. Now, if I can in bulk do this, right, my bank is more willing to do it and put it on the line because I got a bunch of them. And what's the likelihood of, all this basket of loans failing? But if I'm doing one or two of them, now I've got a big sale because my bank doesn't understand them. I still got to package and sell it. And it's a lot of like layered, thin slices. But yes, it comes down to being an administrative issue related to the capitalist engine behind it that's driving this whole thing.
It all makes sense, and I think that it's, the goal of this, roundtable each month is to leave people with some food for thought. Obviously, we're talking about lending and real estate trends and, the market. But, what we're hearing is there's this paradigm shift that is happening. And I kind of see it as well, too. I mean, and all of us have, maybe experienced it, with whether you're trying to, work with the SBA or, with different programs. There's this administrative backlog whenever it comes to government programs or programs that are, these big, giant, Goliath programs that need a lot of administration, we might not have the bandwidth or manpower for it. And it could actually have some residual impacts that we didn't anticipate for, but on the conventional side of things. And I think that's, where we were, talking about things pretty much kind of evening out and maybe even, being on the downward slant. So, as far as final takeaways for, the folks who may tune into this, do we want to kind of go around and what do you think where do you see the real estate market going as far as financing over the next, maybe 3 months going into the spring market? I'll throw that out to you, Dinesh.
I want to answer your question with a question to the agents, because I was in Philly recently talking with some other agents, and what they told me was very interesting. They're telling me that there's still situations where a single house is still getting 10 offers.
In some cases,
and they're saying what they're saying the reason for that is that there are a lot of sellers who are sitting on the fence, and part of the reason is that because rates are high, they don't want to buy a replacement house that's going to have a high interest rate, especially if they have a 3% rate right now. They don't want to sell and then be paying 6% on the new house. So I think really the health of the market is really going to come down to what the inventory levels are like. And so hopefully if rates go down, that will then entice sellers to get back into the market, and we'll therefore have more inventory, and then we'll have a healthier market than we did before. So that being said, is that for the agents on the call, is that something that you're seeing where inventory is still low, or are you seeing a lot more houses come on the market? Because I think ultimately that's going to determine where the whole, where the market is going.
Well, I'll just say really quickly, I think that, over the last, I would say month, things have really picked up as far as, activity on both sides, listing and, I've seen it on the buyer side and the listing side. We actually, have gotten into multiple offer situations as far as offers go. So I do think that's, still the case. 10 offers that may in some cases maybe, but there's no question that there's still buyers out there who have the money, who will buy, and the sellers, I think they're getting the message that the heyday is over and that you've got to price it appropriately or you're going to sit, and if you sit, you probably are going to sit for a while. So I don't know what everybody else's experience is.
So I have, sorry, go on.
No, go ahead.
Thanks. I have a new listing, just 11 days old. It's right in the Arboretum community, 2107 Rand Place, Northeast. Ebony, you and your team, I'd love for you all to bring the buyer. We are learning as we go here. And we listed last week, Monday, the 23rd, for 1.158. They've rebuilt the home from scratch. I mean, from the foundation up, and it's really nice. I'll send you the listing link later. And we just, this afternoon before I joined the call, we just dropped the price to 1048. Now, we did that for a few reasons. There's a U-Haul across the street in Bladensburg. But then, this is a pretty unique community, and there's a lot of traffic we got at the open houses. And all of the homes that are listing around, Brookland and Woodridge, they are all dropping their prices by about 50K or 100K in 2 or 3 steps, and then they're going under contract. So I think because interest rates shot up by 200 basis points between late August and second week of November, from 5.5 to 7 pretty much, or from low 5s to 7, that kind of killed the fall market. So there's that demand compression that's releasing now as interest rates come down, plus the favorable seasonality of spring for fee simple properties in the whole DMV. So I think it's, as long as sellers come down, I mean, the ones that are coming down on their prices and accepting that this is not 2020 or 2021 or even early 2022, I think you'll see homes move. So that's my direct experience. We've got a lot of interest. It's just going to be a bit of a challenge to get it up to the million mark, because in that community, I mean, you've got the Arboretum, that's unique. Have something like that.
This is sage advice. This is sage advice, and it's called price cures all. Price cures all. So with those wise words, join us next month. I can't believe that we're already at 6:30, but if you've got questions, you know where to reach us. You can get us at info@thebatesinternationalgroup.com. You can also please like our Facebook page, as well as subscribe to our YouTube page. We have videos that come out every single month, so we appreciate it. First Thursday at 6 o'clock to 6:30. Dinesh, we really appreciate you coming on, and for you, giving us all of your sage advice, as well as Nicole. We love hearing from you. Thank you. And Pratish, thank you as well. Mohammed, you're awesome. So does anybody have any final last words, because we're headed out?
One last word. Inventory is still low, and price does cure all. I don't see inventory spiking up anytime soon in the next 6 to 12 months. So price accordingly. With interest rates being as they are, definitely price accordingly.
Oh, one important thing. Sorry, Mohammed, are you done?
I'm done.
Yeah. Ebony, before we go, something important. I think the lenders will be aware of this. There is something called the HAF, Home Ownership Assistance Fund, that was set up by the Department of Treasury.
Put it in the chat too. Put it in the chat.
Yeah, I think
everybody put their info in the chat.
Yeah, this is very important, because what they did was, so they piloted it last year. I think it began under Mnuchin, and then when the administrations changed, they continued. So 36 states or so have entered this program. And I personally know somebody who's benefited from this. What it is 36 states that have entered the program, they are issuing grants without much, looking for income tax returns or whatever. They're basically taking independent contractors and business professionals at their word. For those who have fallen behind on their mortgage as a result of COVID, and they're being very liberal about the definition and requirements as a result of COVID. So I personally, for example, I had many in the pipeline in the first quarter of 2020, condo listings and so forth, but all my buyers happen to be independent professionals, so they put off their plans. So I suffered in 2020. That's just one example. So if you're behind on your mortgage, you can get this grant, and they started at 40K limit per mortgagor, per homeowner who's behind. It has to be your own home that you're living in, not investment property. And now they've increased it to 50,000. And they are actually awarding. I know that firsthand.
And what's the name of the program again? Can you give it?
HAF, and then VMRP is Virginia Mortgage Relief Program, and then DC must have its own, Maryland must have its own. I'll send you all this.
Okay.
Yeah.
Okay, and quickly put it in the chat too. And Nicole, if you want to put your info, go ahead and do that. So we appreciate everybody for being here tonight, and we're going to go ahead and wrap things up, and we'll be back here next month, same time, same link.